Welcome back. After the massive win on the Portillo's trade, I'm here with something else. Now, if you haven't seen the video on Portillo's, do yourself a favor, put it on your watch list. You'll thank me later. By the way, we made 667% return on that trade only. Moving on, today we'll speak about another short trade idea. We're talking about CarMax. But before we get into it, guys, this is not financial advice. This is purely for educational basis. Do read the disclaimer. And for the love of God, no copy trading. CarMax is a retailer of used vehicles in the US. It operates both in the retail and wholesale areas. It trades on the New York Stock Exchange at around $81.7, which is a market cap close to 13 billion. That puts it at a forward price earnings ratio of 26 times. In the next 12 months, analysts expect earnings to grow by 24%. That would explain the relatively high forward PE of 26 times for CarMax. If you look backwards, you'll see meaningful reductions in both revenue and earnings. What we are really trying to find out here is whether analysts' expectations for the future will be met or not. We can only do that by studying what's happening in the industry at the moment and also understanding the company's business model. CarMax predominantly sells used vehicles to individuals. It also operates in the wholesale space and has its own auto finance arm. The business model is quite simple. It acquires vehicles and then sells them for a gross profit. On the lending side, it's able to generate an interest margin. In terms of operating costs, it has overheads and occupancy costs, and then it also has to keep loan loss provisions. This is basically a reserve for all the loans that it thinks people might default on in the future. We've seen significant reductions in both revenues and earnings. This shows us how sensitive the company's fundamentals are to the used car price cycle. During the pandemic, a combination of supply constraints and stimulus checks caused used car prices to go significantly high for a very long time. We believe that we've reached the peak of the used car price cycle. We also think there might be a risk of significant deterioration from here, and that companies that are as cyclical as CarMax will be impacted quite significantly. Let's look at what's happening in the industry. At a wholesale level, car prices keep falling. Now, even if CarMax only has 20% of its revenue linked to the wholesale segment, we really want to understand what's happening at the wholesale level because we look at this as a bit of a leading indicator to what will eventually happen to used car prices at the retail level. Not surprisingly, car prices are also falling at the retail level. So this is where CarMax has the biggest exposure. And we believe what's happening in the wholesale segment will eventually translate into the retail segment too. And of course, the auto sector will not be immune. During the pandemic, people were getting a second vehicle because they probably did not want to go into public transportation or they had extra purchasing power and they thought it's a good idea to get a second vehicle. None of that is happening now. On the lending side, we are seeing increasing rates of delinquencies. This chart is from Ali, a major auto loan provider. Now, one could argue that this is a normalization in delinquency rates, but if you think about it, if we get a bit of weakness in the job market, then there's nothing to say that this cannot go much higher. And we know that the majority of auto purchases are financed by credit. It's a sector that is very sensitive to interest rates, delinquencies, availability of credit, cost of credit. With all that said, we believe we have reached cycle peak. Used car prices will keep falling and keep hurting the gross profits of companies like CarMax. The higher interest rates is definitely impacting affordability from a customer perspective. Credit is also becoming less available. We are hearing of things like lower loan approval rates. Even CarMax is heavily dependent on credit. If credit is becoming less available and more costly, it's bound to have a negative impact on the earnings of CarMax. And we know that the majority of auto purchases are financed by credit. It's a sector that is very sensitive to interest rates, delinquencies, availability of credit, cost of credit. With all that said, we believe we have reached cycle peak. Used car prices will keep falling and keep hurting the gross profits of companies like CarMax. The higher interest rates is definitely impacting affordability from a customer perspective. Credit is also becoming less available. We are hearing of things like lower loan approval rates. Even CarMax is heavily dependent on credit. If credit is becoming less available and more costly, it's bound to have a negative impact on the earnings of CarMax. Low consumer confidence translates into reduced demand for autos. People could opt to delay discretionary purchases. From here, we could see higher delinquency rates that will impact loan quality and cause companies like CarMax to increase their loan provisions. This is definitely negative for earnings. We could also see the job market strength waning. At the same time, falling car prices create what we call negative equity for car owners. So if you're in a tricky job situation, that might increase your propensity to default on your car loan. What we normally see with higher delinquency rates, and we're starting to see that to some extent, is an increase in car repossessions. This is going to further fuel the decline in used car prices. So, how do we play these catalysts? How do we express our view? The stock is currently trading at 81.7. We believe it could get to 60 after earnings, which is in 2 weeks' time. That's a 21% drop. I've been buying puts that expire on the 20th October with a strike price of 70 at an average price of $1.8. At the price target, the puts should be worth around $10, which would give us a potential profit upwards of 500%. We have to consider the risks to the thesis. Car prices falling is not news. Everyone knows about it. It might be largely priced in. The market could just ignore any negative news and look ahead to the next few quarters. CarMax is also able to further control costs and offset the impact of falling gross profits on earnings. The trick here is really understanding the pace at which gross profits might fall and the ability of CarMax to be able to control the operational cost further as a way to cushion against that when it comes to earnings. We could also have a macro event where the Fed decides to cut interest rates aggressively, although that could mean that the economy is in deep trouble, so not really sure which way that would go. What if the job market stays strong and delinquencies have actually just normalized and they stay contained? The market will look at this positively versus the situation where we are predicting a cyclical downturn. So we have to be very careful of that. There's also a little bit of a situation happening in the US with the UAW strike. So that could potentially reduce the supply of new cars and give a little bit of upside pressure to used car prices. So I don't really think that that will make a big difference because really what we're looking out for here is like the next 6 to 12 months. And I think like a one-off event like this, maybe it causes some disruptions for a couple of weeks, a month or so. But in the longer term, I think the cycle has really peaked, and that's basically what would determine the fate of these companies. Well, thanks for listening. Please do subscribe, share your thoughts, comment, like, do whatever you want. Feel free to ask any questions that you might have. If you want to troll, go ahead. I've got my first one, by the way. It's very, very special. So, yeah, I mean, I hope this was useful. Like I said, this is only for educational purposes. So, please be careful out there. Take care.